remember on May 1st of 2023 when Elon Musk said this. Mark my words, Elon Musk warns of a severe recession and criticizes the latency of the Fed's data. Today, Nvidia became the most valuable publicly traded company in the world. Richard Bernstein went on CNBC yesterday and basically warned about your big tech stocks. Not basically, he did. And he's like the only one to have anything negative to say on big tech in a very long time. So I think it is paramount that you listen to this clip. We'll talk about it, break it all down, what this means for our markets, for Tesla stock. What's my take on all of this?
Markets are hitting new record highs. My next guest says the Fed's 2% inflation goal won't be met without an extended period of subpar growth. And he's noticing an odd divergence between the performance of large small stocks and quality to junk bonds. And he says it could be a major warning sign. Joining me to explain is Richard Bernstein. He's CEO and Chief Investment Officer of Richard Bernstein Advisors. It's great to have you here. And is this a change in tune, Richard? Normally when we talk, you sort of reassure me that everything's going to be all right.
Right. Well, Kelly, I think the question is not whether one's bullish or bearish. I think it's bullish or bearish on what. And, we're basically very cautious on 7 names, the 7 names that everybody knows, the 7 names that are distorting all the indices, as you just pointed out. But realistically, we're pretty bullish on everything else in the world. And I think that's really the dichotomy. I think everybody knows we have a bifurcated market. It's hard to believe that the opportunities outside of maybe the next 10 minutes are in that group of 7 companies, right? Everybody knows about them. They're flush with capital. There's no surprises. But yet the other side of that seesaw, if you will, is historically broad and historically undervalued, and their fundamentals are improving, and nobody cares.
So I'm so glad I'm just so glad we're having this discussion. Okay, so some might say, and if you look at the first quarter, David Kostin highlighted over the weekend as well, the big 5 earnings growth, exclude Apple, their earnings growth was 84% year on year in Q1. The rest, the median S&P 500 earnings growth was 5%. Which would you rather own? I want the 84%. So it's interesting to hear you say, listen, the leadership is too narrow and you should look to everything else. And I'm thinking, I think everything else looks pretty bad right now. And I'd rather stick with what is showing this phenomenal growth.
Exactly. I mean, that's what the common thought is, that we want these fast growers. But the reality is, if you look at analyst forecasts, those growth rates in the Magnificent 5 or 7 or 2, or whatever you want to call them, are supposed to slow pretty dramatically as you go through the year. Meanwhile, if you look at small cap earnings expectations or emerging market earnings expectations, by the end of this year, both small caps and emerging markets are forecasted to grow faster than the Magnificent 7 earnings growth. So it's a matter of relative earnings here.
You really think
it's actually true.
So.
Yeah. I mean, if nothing else, we have to remember that some of these companies are much more cyclical than people think. I don't want to point out individual names. They are experiencing tremendous cyclical surges here. But the difference is, normally when cyclical stocks have a big cyclical earnings surge, multiples compress. This is very unusual in that we're seeing this big cyclical surge and multiples are expanding. That really should be a warning sign to a lot of people about the sustainability of this growth. Look, Kelly, the way I would describe it is, we all know that a Maserati is a great car, right? And if I tried to sell you a Maserati for a Volkswagen price, you'd buy it in a second. You'd ask me for 2 or 3 of them. But if I tried to sell you a Maserati for $2.5 or $3 million, you'd say I was nutty. How come people understand that when it comes to cars or any economic transaction? You go to the stock market, and all of a sudden the Maseratis are worth $1 bazillion.
Let me put it a different way. And I drive a Honda and a Subaru, sedan. So I'm with you, believe me. But
I don't drive a Maserati either.
To put it this way, if I were to say, I'm actually quite concerned about some of the larger signals we're getting on economic growth. You talked about this: unemployment rates rising, the consumers clearly starting to become a little tapped out, et cetera. The only thing I might feel comfortable owning in this market is the kind of stuff that's less exposed to that and is more exposed to the AI complete revolution that we have to build out. I would much rather be in those stocks. Why do I want to be in McDonald's or Starbucks or, anything that would possibly face this couple percentage point erosion at the margin we could be heading into? I want to be over in data center and cloud, whatever it is that's going to support this new build out. So it feels ironic to say that I would be more comfortable with the far overextended trades than I would be with everything else right now.
So Kelly, that's kind of like what people were arguing during the tech bubble, that there was going to be the build out of the internet, there was going to be the build out of fiber optics, and that was the place to be. They were right. There was the build out of the internet, there was the build out of fiber optics, but because the stocks were so expensive, there was little room for disappointment. And what happened was,
as you know, this is 84% earnings growth in the first quarter. These are stocks trading at 30 or 40 times forward. This is not pets.com.
Well, that's Kelly. I hate to say this.
Go
it's a little bit selective memory there. It's a little bit selective memory.
I have no real memory there. Go.
Yeah, there were real companies in the tech bubble with real cash flow, real balance sheets. And if you bought those real substantial companies that now like nobody would care about, like IBM, right? That was a big substantial company back then. Cisco. Right? Not SYY, SCSCO, right? These were real companies with real cash flow and real balance sheets. And what happened is if you bought them at the peak of the bubble, it took you between 5 and 20 years just to break even.
I think that individual is correct. I think he will be proven to be correct over the next 6 to 12 months. Earnings growth is slowing down among your big tech names, and it's accelerating with small and mid cap stocks. And I think if we avoid an outright disaster due to the economy slowing down, due to AI underwhelming, either of those two things could cause a disaster at this point, it's going to lead to one thing happening. Small, mid cap stocks, interest rate sensitive stocks that will start to massively outperform. In other words, I don't think all of the gains coming from just a handful of stocks is going to continue. Now, could it for a little bit of time? Of course. I'm typically early with any, downside projection or any change of market internals, but I do tend to be correct over time. A lot of people pointed to ARM. That was really the last stock that I gave a big warning on. I was making videos about ARM in February and in March. What happened was ARM ultimately ended up falling from peak to trough about 48%. I was a couple weeks early, but you did get ARM that fell almost in half. Now, sure, has the stock rallied back? Of course, and that's furthermore to my point of this video. It's out of control. AI, that is. Whether you're looking at ARM, Broadcom, Nvidia, Dell, or any AI adjacent company, it's where all of the invested capital is going. That is because AI is really a multi-decade trend, and AI is not going to leave your life. AI is here to stay. The problem is when everyone is this bullish and optimistic and creating justifications to buy stocks at much elevated valuations, when you haven't got any downside surprises in over a year now, you're just creating the justification needed to FOMO. And that's what you're seeing right now in AI stocks is FOMO. Now that's fine as long as demand holds up and these companies continue to hit their numbers. But the Fed last week changed things for me. The Fed last week made it clear that they are not going to cut rates until the economy weakens enough to which they can feel confident inflation will come down. I know the Fed says, they need to gain further confidence with more inflation reports that inflation is coming down to 2%. No, let me translate what the Fed actually said last week. The Fed said, we need confidence that the economy will continue to weaken and that will push inflation down to 2%. Meaning the Fed is really just waiting for a really bad jobs report, a really bad unemployment rate, and maybe more than one is the craziest part about all of this, to start the process of cutting rates. Jerome Powell made it very clear in 2022. And nobody is talking about this. Jerome Powell said, just flat out, and the markets did not like it. He said, we would rather go through a recession than have elevated inflation for a period of time. Now, obviously, I'm paraphrasing, but that was the gist of what he said. Basically, the Fed will sacrifice the economy in order to make sure inflation comes down and stays down. And typically that's what happens, because during a booming economy, when there's inflation, well, normally that boom economy causes inflation, and ultimately monetary policy and fiscal policy are the sole drivers of inflation. It's not necessarily a booming economy. It's the government printing money. It's the Fed's easy money policies for decades. But at this point, that's probably correct. You need to see some economic weakness. Now, if we actually used proper inflation data like Europe, then we would know inflation's already down to the Fed's 2% target. But unfortunately, they don't use the European style of calculating inflation. So yeah, the Fed's forced to push us into a recession. Now, I'm telling you this well ahead of anyone else, okay? You're not going to see another video like this on YouTube, on CNBC, or anywhere else. And that's fine, because I'm perfectly okay with being early with my commentary. I don't want to say predictions, projections, because, you know, I mean, a clock's right, you know, twice a day, right? No matter what the prediction is. Eventually there will be a recession. Eventually AI, you know, will prove to be too hyped in the near term. I don't think those are predictions, more so than factual, okay? The problem is, per the market's projections right now, there is no recession coming anywhere in the near term future, not the next 12 or 24 months at least, with EPS growth rates expected to be over 14% for next year and about that for this year. Albeit the economy is weakening, retail sales came in not so great today, and the unemployment rate is rising, right? All of these things would lead to, in a typical cycle, a heightened risk of recession, and the markets are not looking at that. I think most of which is because of AI. And if you guys want my honest opinion, I'm pissed off, because do you know who's going to end up holding the AI bag until all of these expectations actually materialize? It's going to be retail investors. It's going to be you. And I know that's unfortunate to say. A lot of big money is also involved in your AI trade. They are much better at hedging. They're much better at selling. And they will do that when the time comes. And, you know, again, I'm an uber bull on NVIDIA longer term. I'm an uber bull on generalized AI, you know, in the long term. But the expectations are way too high right now. And this has really distorted investors' expectations for what to expect out of the markets, the economy, a soft landing. It's infected everything else. And again, I think it's a little too premature to have NVIDIA, the most valuable company in the world, when 90% of the US population has no idea what NVIDIA is. I feel like that is an arbitrary kind of red flag, kind of like The Big Short, where they go to, what was it, like the strip club, and the workers there have multiple houses. And just say whatever they want to get the loans. That's kind of how it feels to a certain less raunchy degree with AI, with NVIDIA, and the craze that we are currently seeing. And it really pisses me off with this projected safety that NVIDIA has and other AI companies. Keep in mind, I have exposure to NVIDIA. I'm not short NVIDIA at all. Not short the entire, you know, semiconductor sector. I do have a couple puts on the markets just to be clear. I don't really care what happens with those. They're hedges for the next couple of months. So whether I'm right or wrong, I look at it two ways. Either we see a broadening out of our markets and I do well, or we see, you know, what I'm saying in this video come true and I do well on the hedges. Either way, really don't matter to me because it's a very small percentage of the portfolio anyways. So I really have no bias, I guess, to any of this in any kind of material way. It's not like I'm shorting the entire sector and, you know, coming out making this video. But I'm pissed off for those reasons. Semiconductors are cyclical, and I'll tell you what's going to happen before it happens. No, I'm not a fortune teller. It's obvious. Wall Street knows this. They're not going to tell you that because they want you to hold the bag on AI, at least for a while. When the first miss from Nvidia comes or whatever happens, the implosion. But what's going to happen is this. All of these companies have bought these Nvidia GPUs. They don't need that many more. So when the economy weakens, when there's trouble ahead at Amazon, Google, Apple, Microsoft, Tesla, whatever company it is, these companies, they're going to say, we already have enough Nvidia GPUs. We are already not making money on any of our AI endeavors. It's actually a cash bleed and just continues to be a cash bleed for the foreseeable future. Like, these companies don't even have a plan to monetize AI. They're just going balls to the walls on GPUs, which is fine during a boom economy. But when things start to go bust, which they always will during high inflationary periods, that's where you get a problem. That's where investment slows down in AI in your cash burning areas. And that's when we figure out semiconductors are cyclical, as they always have been. Nothing necessarily changed from that perspective. And it's not like there's a lot of companies that need these NVIDIA GPUs either, right? You're a Silicon Valley firm, you're, you know, a tech startup, whatever it is. Those are the companies, big tech companies. Those are the ones buying the GPUs. So it's not like average everyday people are buying NVIDIA H100s, right? So the pool of people to even buy those chips are, you know, pretty small to begin with. So once the capital expenditure starts to slow down at some companies, it already has at Amazon and Tesla for NVIDIA GPUs, then it's going to slow down a lot more. And I don't know when that happens, but I know it will happen. And Wall Street is not prepared for it. Retail is not prepared for it, but I do know retail will be the ones left holding the bag, like they always are. So I'm really pissed off for those reasons. And, you know, as things start to get better throughout the second half of this year in small and mid cap stocks, retail is going to be so afraid to touch them because of what big money is saying, that by the time retail, you know, understands that's where the growth now is, big money's already gonna have left them holding the bag in a lot of AI stocks. And they're already going to be in those areas anyways. And, you know, maybe not. Maybe we ultimately go into a recession and everything does bad. That's a possibility as well. Either way, I don't think this ends well for a lot of retail investors. Like, take a look at this fund manager survey Bank of America does each month. This is for the month of June, so the current month that we are in. It says this is the most bullish fund managers have been since November of 2021, driven by cash levels at a 3-year low and big equity allocation. So fund managers have little to no cash. They're all in stocks. Yeah, that's not good. Notice the last timing as well, most bullish since November of 2021. As a couple of these comments say, 2022 turned out to be a real dinger, and November 2021 was a top. Yeah, usually when sentiment gets this bullish, it is a top. And this whole narrative around a soft landing or no landing, it's just a bunch of BS. There will be a recession. The Fed will cause it. And that, at this point, is a fact in my personal opinion. What this actually feels like in our markets is a blow-off top rally before you get that ultimate, you know, come back to earth reality type correction. Feels like I'm standing at an oasis in the desert with some fresh water there, and everyone's walking around blind, can't see it, asking, where's the water? Like, it's right in front of us. All of this information is right in front of us. Like, if your bull case for our markets is the Fed cutting rates at precisely the right time to stop any, economic instability, if that's your bull case, your bull thesis, which it has to be right now if you are bullish, I mean, yeah, that's a tough argument for me, given the weakness that you are already seeing and have been seeing with the consumer. I mean, McDonald's, Starbucks, Walmart, all of them warning about the consumer. I think the data is very lagged. And I think over the next couple of months, we're going to get some data that really puts that question back in people's minds again. Do you remember on May 1st of 2023 when Elon Musk said this? Mark my words, Elon Musk warns of a severe recession and criticizes the latency of the Fed's data. Or this on June 15th of Elon Musk warning about a new economic problem that is looming. Or what about this back in April from Fox Business? Says Elon Musk warns of tough sledding for U.S. economy. Elon Musk said, quote, tough sledding until spring. Next year is my guess. He wrote that in a tweet on Wednesday. I mean, even back in 2022, this article is from October 21st, 2022, Elon Musk says a global recession could last until the spring of 2024. I don't think Elon was wrong in any of that. I think the combination of having botched data, outright inaccurate data, is making it look like the economy is a lot stronger than it really is. Go ask people. Go walk the streets. You are in a recession. Take a look at the Michigan Economic Current Conditions survey that just came out last week, hitting its lowest level in this entire tightening cycle so far, besides, that period of June of 2022 where you hit 53.8 points. This is like, great financial crisis lows. Now, why was sentiment so low back in June of 2022? Well, it was super high inflation, the inflation shock, if you will, at the grocery store. Also, this survey tends to follow to a great degree what stocks do, right? So sentiment tends to rise when stocks rise. It tends to fall when stocks fall. And that was even more surprising, during this fall that stocks are sitting at all-time highs. And a matter of fact, this might blow your minds. In recent years, the only time you have seen sharp drawdowns of this current economic conditions survey, you have been in a recession, okay? You have been in a recession already. Yeah, literally every time you see a big drawdown, you're in a recession. And you're seeing another big drawdown, like one that is pretty unprecedented on the whole, max chart of this survey itself. So again, I don't think Elon was wrong, and I don't think it's the end of the world for Tesla when this recession comes, when the crash comes in the markets. I think anything, around these prices is a really good buying opportunity for Tesla. Regardless, today's prices are a good buying opportunity. Tomorrow's prices likely will be. Tesla in the 160s, fantastic. 150s, 140s, or lower than that, fantastic. Again, it's more important when you buy a stock, not necessarily when you sell a stock. You gotta buy a stock at a good price, and you will always make money, right? In due time. You buy an undervalued company. If you see something the markets don't, again, that's not financial advice. Not every good company stock you buy, you'll make money, clearly. Hopefully you guys understand what I mean. But if you overpay for a stock, then it could take years before you make money again. You may never make all of your money back. And that's kind of part of the problem I see right now is, even if you'll make money eventually, if you're buying Nvidia at all-time highs like today, it could take a very long time. And I know a lot of people are going all in on Nvidia right now. I know a lot of people, are putting their life savings in Nvidia right now. And think that's just a little dangerous when retail will be left holding the bag. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. If you guys do want to come trade with us live in real time, check out that link down below in the description of this video. You'll get notified every time I make a trade, every time I hedge the portfolio, go long, sell something, you'll get notified. So, but that is it. Thank you guys for watching. Enjoy the rest of your day, and I will see you in the next one.